You're watching BCTV. We're all about Brantford. You're watching BCTV, Brantford Government Television, a service of Brantford Community Television. This program is brought to you in part through the support of the town of Brantford.
I'll open the meeting for the Town of Brantford Board of Finance regular meeting dated February 22nd, 2021. And first on the agenda is to approve minutes of the January 28th, 2021 meeting.
I'll move those, Joe. I read them and I'll make a motion to accept.
Okay, a motion's been made by Charlie, seconded by Jeff. Is there any discussion among the board members? If not, all in favor?
Aye.
Aye. I assume it's everyone. No opposed? Okay, we'll go on to item number 2, which is citizens' comments. And this is on the agenda for the public to speak with regards to any agenda items. Anybody from the public wish to speak at this time? I don't believe so. Lisa, you're not hearing anything, are you? Or seeing anything?
I do not see any hands up, and I do not see that anyone is looking to speak. Thank you.
Okay. All right, so we're going to move on to agenda item number 3 is to hear presentations from the Andriel Group and the GYL Financial Synergies Group with regards to the performance of the town of Brantford's police pension plan. We will then hear from the same folks with regards to the volunteer fire incentive plan, and then we'll go on and review the other post-employment benefits trust, affectionately known as the OPEB trust, by the same folks. So welcome, Rob, I assume, and Luke and Michael and Charlie. Thank you.
Good evening. This is Robert DeLuca. Joe, thanks for having us here this evening. As customary, I'll kick off the presentation and provide a backdrop of the markets and the economy for the reporting period for the quarter ending December 31, 2020, and provide some additional commentary of the market and economic environment year to date to bring us to current. And that'll shine some good perspective on the data that Michael and Luke will take us through for the experience of the 3 funds. So, as you all know, we went through an extraordinarily volatile 2020. The fourth quarter ended the year with a very strong rally in the fourth quarter of 2020, and overall equity markets were significantly higher. In the fourth quarter, it was actually led by small companies in the U.S., followed by mid, then large, in the fourth quarter, with small companies having a return in excess of 30% for the quarter, with a return for the year of almost 20%, whereas large companies, as measured by the S&P 500, in the fourth quarter were up over 12%, with an annual return of just over 18%. So a very strong year as we work through massive volatility that we experienced in the spring of last year. And the international markets also regained their footing in the fourth quarter, where we saw the developed international markets up over 16% in the fourth quarter, bringing their year-to-date number to positive almost 8%, and the emerging markets up almost 20% in the fourth quarter, bringing their year-to-date number up to positive 18%. So obviously with those numbers, you can see how they were negative prior to the fourth quarter and the meaningful returns that we've seen during that period. So as I said, large cap led the market in the first half of the year. Small cap took leadership in the last half, in the last quarter. We further saw some changes in the bond market, where we saw longer term interest rates more recently move higher. But on the year overall, we saw interest rates decline for the year quite significantly across what we refer to as the yield curve. So we saw the interest rates, as you know, early in the year, the rates were slashed sharply by the Federal Reserve, and the Treasury market, which prices bonds, came down quite significantly. The recovery from the recession of 2020 continues to hold ground. We saw the GDP for the fourth quarter at positive 4%. That brought the full year GDP number to negative 3.5%. And we're seeing a forecast for growth in 2021 at just under 5%, and an expectation of 2022 to see growth temper a little bit more down to about 3.5% in 2022. Pairing up with that, we're seeing employment data trends improving. We see the unemployment rate come down to just around 8% currently, and tracking to expect to decline closer to 6% by year end. So it continues to be a very good improving trend from an employment perspective. Obviously, the effects of COVID-19, of coronavirus, are still being felt in various industries and sectors throughout the economy and throughout the globe. And I'd say we as a collective, we are starting to feel a little bit better with the administration of vaccines occurring as something that will help reopen the economies and help commerce commence again back at levels that we've seen in the past. So we're seeing that as a positive outlook, and that's what's contributing to the forecasted GDP growth numbers for 2021 and 2022. What's also interesting to note is last year in 2020, we had a meaningful impact in the energy sector, where energy stocks were punished and oil prices declined sharply. Year to date, we've seen quite the opposite occur. So as I'm starting to mix last year's information into what's going on currently, so we've seen energy prices moving higher. We've seen other commodity prices move higher as well. So this ties into a little bit more of what's going on in the bond market. We're seeing longer term interest rates, as measured by the 10-year Treasury and the 30-year Treasury, have moved higher this year, which is an indicator to us of positive economic activity, and albeit very low interest rates, an expectation that inflation will gradually creep into the system. The Fed's inflation expectations and the market's inflation expectations are still pegged around 2%, which is their optimal target. So if we could continue to stay there, we'll be very healthy for the economy. And the Fed has also indicated that they would be willing to let inflation run above target as we navigate the outcomes of the environment we've been through. So as I mentioned, started to transition a little bit more to year to date. The markets have continued to move higher across the board in the U.S. equity markets as well as international. And that's been led by the riskier assets, and small cap equities as well as emerging markets have continued to lead the way. From that leadership from the fourth quarter of last year has carried forward into January and February of this year. So the riskier assets are being rewarded at this point in time with more attention and higher returns. We'll continue to see, stimulative Fed and stimulative central banks globally. So as we look at the federal, monetary and fiscal policy on all regards are net stimulative. So continuing to add money and add liquidity into the systems as a way to help bolster the economies around the globe and to generate positive activity. And we expect that to continue for the immediate term. There'll be conjecture about the political side of this over what happens with the current bill that's proposed and subsequent bills. However, we do expect there to continue to be net stimulus that comes out of Washington to bolster the economy. So that's kind of a good snapshot on the economic data. I don't want to bore people too much, but I wanted to give that good encapsulation and turn things over to Michael to take us through the experience of the funds, and then, I'll add in some additional commentary as well as we go through there.
All right. Thank you, Rob. Mike?
I'll actually be covering the performance.
Oh, yeah. Luke's going to review the performance. And Luke, do you need me to share my screen, or do you have it up?
No, I have it. Lisa, do we have the ability to share our screen?
Yes, this is Lisa. Go ahead.
Okay. Just a thumbs up if everyone could see that. Okay, great. Thank you, Rob. Once again, I'm Luke Violet from GYL. I'll be covering the performance summary for the three respective plans tonight. In usual fashion, we'll start with the police pension plan and cover some of the high-level statistics. In regards to the Town of Brantford Police Pension Plan for data ending December 31st, we're coming on just shy of 18 years worth of data with an annualized return of 5.98, slightly trailing that of the policy of 6.08. As you can see here, the total return over that time period is in excess of 180%. If we look at some of our risk summary statistics, we have 9% less overall volatility in comparison to the market measured by your beta. This is also further evidence in your annualized standard deviation, which is a measure of portfolio risk of 7.59 versus 8.22. And with that, we receive a slightly positive risk-adjusted return, or alpha, 0.03. Putting the plan's performance in dollars and cents, if we take a look at the summary of cash flows table at the bottom of the page here, we can see the last 3 months column. The beginning market value as of October 1st was $26,147,666. Ignoring contributions and withdrawals, as we did some money movement and rebalancing activity in the fourth quarter, bringing us to a net cash flow of negative $472,019 and a net investment change or earnings for the quarter of $2,679,382, bringing us to an ending market value of $28,355,029 for the period ending December 31st. And if you pan from left to right, you could see over the longer time period how the plan has performed. Most notably, the fiscal year to date, from July 1st through year end, the plan is just shy of $3.5 million in earnings. And you could also see your year to date or 1 year number for 2020, which was such a challenging year, not only for the market, but for so many in general. The plan was up $2,175,331. We move forward to the plan experience at the policy level. We could see, as Rob alluded to in his opening remarks, it was a very strong quarter that we rallied into to end the year. The plan performed in line, although trailing a bit for the quarter, 10.37 versus 11.01. Also for the fiscal year-to-date return, positive 13.87 versus 14.33. And looking at the calendar year for 2020, a positive 8.35 versus 10.06. And then if we date all the way back to the inception of April 2003, dating back to the performance report history of 5.98 versus 6.08 over that time frame. You could see below the plan and policy the asset class sleeves and their corresponding performance. The equity markets as a whole Had very strong performance, not only domestically, but internationally as well. We do hold some real estate as well as master limited partnerships, which Rob alluded to it at the ending remarks, how we've seen energy and commodity prices on the rise, especially in 2021. We have our fixed income mandate, which is managed by Mesirow Financial. Muted in the fourth quarter in terms of our returns. However, they have a conservative nature and approach. But if you look at the year-to-date numbers or the one-year category, very strong numbers from the fixed income mandate. And then we complement that with a conservative allocation to high-yield bonds as well, which also trailing that of the benchmark, but offering some exposure in a conservative nature. And we saw some of the triple C graded bonds doing a bit better than the credit quality that we adhere to. But all in all, the police plan for not only the fourth quarter, but the calendar year of 2020 had a very strong return summary. With that, the plan as of this past Friday, close of business, had a market value of $29,064,438. And after taking into consideration contributions and withdrawals, there have been earnings of approximately 3.7% to the positive since quarter end. And with that, we are going to make a recommendation to the board in terms of rebalancing the police pension plan. We would recommend that we perform a full rebalance back to target policy, which will further allow us not only to align the portfolio, but to replenish the cash to its target to ensure we meet future benefit payments.
Do we have details on that, Jim, with regards to the rebalance?
We do, and Luke or Lisa, can you bring up that police rebalance worksheet?
Sure, I have it right here.
And while they bring that up for you all to see, what you're going to notice is the amount of assets and equities has continued to increase, and that percentage has gone from 57% at the end of the year to 60% currently, which is one of the driving factors for the recommendation of the rebalance to remove some of those dollars from equities, replenish the cash need as we've paid out benefits, and then also the fixed income manager is become about close to 8% underweight their benchmark, so to add exposure there.
Here you can see your cash current balance at roughly 0.7%, and this is your target. We maintain a weight of 2.5. So we'd be effectively filling this bucket to this dollar amount, which will necessitate just shy of $550,000. And as Rob alluded to, taking some of our excess and profits from our equities and dispersing that to the allocation accordingly.
A little hard to see that on the screen. Jim, did you send that out, that rebalance? Did I miss it?
I thought I might have. I can actually shoot it around now, if that helps.
Luke, it's Lisa. Can you maximize your screen, your upper right corner of the screen, please?
Is that better? Did it change on your end?
No.
What happens is maybe it's almost make it smaller because it's kind of hard to see the whole screen.
With me 1 second. Let's see if this helps.
I do have a maximized version, Luke, if you want me to try.
Is that better?
Yeah, Jim, I see it. You sent it out on Friday.
There was a larger one just a couple of minutes ago.
Yep. Okay, so we're moving $1.4 million out of essentially $1.4 million and reallocating that to various spots, various investments.
Correct. We're taking approximately 1.4 million out of equities.
Yeah.
And adding that to cash and fixed income at these levels.
You can see about $925,000 going towards fixed income, the vast majority of that to the high quality at Mesero, and then $542,000 to replenish the cash for benefit payments.
Yep. Okay, board members, any questions on this rebalance for the police pension? If not, I'd take a motion to rebalance.
I'll move to rebalance.
Victor's
second it, Joe.
Jeff is second. Discussion? All in favor?
Aye.
Aye.
All right, I think we're good on the police pension.
Okay.
Now, Luke.
I'll just pivot now to the fire incentive. Okay. Here we have the Town of Brantford Volunteer Fire Incentive Plan for the period also ending December 31st. As we can see here, a shorter time span, 4 years and 10 months, with a annualized return of 6.9 versus 7.41, a total return of 40% and 37 basis points in comparison to 43.83. Also similar risk metrics, as the conservative nature of the assets are invested similar to the police and OPEB at 55% in equities and 45% in fixed income. So we also have 9% less volatility versus that of the market measured by beta, and also a lower risk metric through annualized standard deviation of 9.03 versus 9.84. In terms of the performance in dollars and cents, we look at the summary of cash flow table. We had a beginning market value of $1,272,493 in October, with a net cash flow of negative $9,629, bringing us to a net investment change or earnings of $130,211, for an ending market value of $1,393,074 for the period ending December 31st. At the total plan level, we can see here how the plan performed in line with the overall objectives, given the market experience, not only in late spring, but coming through the summer months and then rallying even more so towards the year end of calendar 2020. The plan performing with a return of 10.28 versus positive 11.01. Also a strong calendar year, 8.63 versus 10.06. And then for your fiscal year to date, beginning July 1st, a positive 13.84 versus 14.33. And dating back to the inception of December of 2015, we have an annualized return of 6.9 versus 7.41. Very similar experience to that of the police pension. Obviously a smaller pool of assets. So we do not have the active management in the fixed income space. It's more passive mandate, but nonetheless, the bond portfolio has done quite well, given the interest rate environment throughout 2020 and now year to date. With that, the current assets for the fire plan as of Friday's close are $1,439,891. And after taking into consideration the plan contributions and withdrawals, there has been earnings of approximately 3.8% year to date. And at this time, we would also make a recommendation similar to that of the police to rebalance the plan accordingly back to target policy, which will entail taking some of our excess from appreciation and equities and filling our buckets predominantly in fixed income. So I can share with you what that rebalance looks like as well.
Okay, so that's moving the 48,000 essentially. I'm sorry, 51. A little different than the one that came up the other day. So it's moving $51,589 out of the equities and again into the bonds. Mostly into the bonds. Okay. Questions from the board members with regards to the suggested rebalance?
I'll move it, Joe. Bob Imparato.
Moved by Robert Imparato.
Jeff will second it.
Jeff seconded. Jeff Villette. Discussion? All in favor?
Aye.
Okay. Thank you. All right, Luke, we can move on to the next, to the OPEB.
Okay. Pulling that up. Okay. And lastly, we have the Town of Brantford OPEB Trust. Also for the period ending December 31st, similar mandate in 55% invest in equities, 45% within the fixed income. We have here 114 months worth of data. So we're at 9.5 years, quite significant. And with an annualized return within this pool of assets of 5.76 versus the policy of 5.91, a total return in excess of 70% throughout that time span. The beta or volatility versus market is even lower in this pool of assets due to some of the cash positions we've held and the methodical rebalancing and deployment of cash over the years. So we have about 16% less overall volatility, and that's further evidenced in your risk metric of standard deviation of a 7.19 versus 8.23. And also a slightly positive risk adjusted return, or alpha, comes along with that of 0.06. Beginning October 1st, we had a planned market value of $24,134,297. Right at the end of December, I believe December 30th, the plan received a contribution of $9 million. So we had a net cash flow of $8,986,686 and a net investment change or earnings of $1,985,939, bringing us to a total market value of $35,106,922 for the quarter ending December 31st. We flip back a few pages here, we could see the plan experience as well as all the underlying asset classes that Rob alluded to in his opening comments. You can see the performance there. But mainly for the quarter, we had a positive return of 8.17 versus the policy of 8.66, and also a strong year-to-date return of 6.73 versus 8.23. And the fiscal year to date from July 1st through year end, just shy of 11% at 10.94 versus 11.29. And then dating back to the inception of the plan, we could see as of July 2011, the annualized return of 5.76 versus 5.91. Here you get a better sense of the underlying experience through the asset classes. We have our large cap stocks, domestic, as well as our mid cap US stocks and our small cap US stocks. As Rob alluded to, the US mid and small cap rallied quite significantly in the final quarter of 2020, as well as complemented with that, our international and emerging markets did do well, even though there were some dislocations globally and obviously with supply and demand throughout the pandemic. But companies found ways to not only add value, but find further opportunities to increase shareholder wealth. And followed by that, we have our small allocation to U.S. real estate, as well as to master limited partnerships. So these are your oil and gas pipelines, which account for storage and processing and transferring of energy and commodities. And then here at the bottom, we have the ballast of the portfolio with your allocation to high yield fixed income, as well as our mandate to fixed income investment grade bonds, as well as a sizable position in cash. In terms of our current assets as of Friday, the plan was valued at $35,902,232. After taking into consideration the contributions and withdrawals, the earnings are of approximately 2.25% year to date. And in terms of any recommendations for the OPEB trust, I believe the finance director provided a memo outlining our proposed strategy, which is agenda item 6, as it pertains to the consolidated assets from the medical self-insurance fund, which derived from a multitude of meetings and deliberations between GYL, Hightower, the folks at Hooker and Holcomb, and the actuaries, as well as the town. So I'm going to pause there. I don't know if Jim has some comments to the board.
Why don't we do this, Luke? Let's see if there's any questions with regards to your presentation.
Sure.
And then we'll move on to the next agenda item, which would be number 6. So,
of course. Okay.
Board members, any questions from Luke or the other folks with regards to the OPEB trust?
I have a generic question, Joe.
Sure, Charlie, go ahead.
How often do we change the policy statistics or the numbers? How frequently are those changed?
Jim can answer that a little better, but we have reviewed it from time to time, and we did. I'd say within the last 18 months or so, there was an adjustment to accommodate some of the other types of investments. But I think it's done periodically, but not. I don't believe it has not been looked at in the last 12 months or so. But I think that's one of the purposes of these quarterly updates, is to see if there is something that needs to be adjusted. But ordinarily, it's with regards to our risk tolerance, and we've also matched the investments to our future liabilities as well. Jim, you want to add to that comment?
Actually, because there's really 3 different pension plans, and in the reports for each of the funds, there's a historical policy tab. And so, for example, I'm looking at the report now, OPEB. If I go, it's not page numbered, but it's towards the back, there's a tab that says historical policy, and I see 11/1/2019 was the last change to the policy benchmark.
Okay.
What is that, Jim? That's in the, I see it. Okay. Yeah, if you go right to the back, Charlie, of the,
It's on your screen, guys. This is Lisa.
thank you.
Yeah, I got it, Joe. Thanks.
Okay. So I think we've been
Thanks, Jim.
fairly diligent over the years based on the advice of Jim and the investment advisors to keep an eye on it. I know years ago we added those, the energy transport, types of investments as well. So from time to time, I guess is the right answer. Any other questions with regards to the OPEB presentation?
Chairman Mooney, this is Representative Brockett. May I ask a question?
Go ahead.
I didn't hear you. I'm sorry.
Yes, go ahead.
Yeah, thank you. Can we get an accounting of where the $9 million came from that was recently transferred into OPEB?
Mr. Finch, can you respond to that?
Yeah, I think that it probably ties in as a good segue to the next item on the agenda. So if Tom's willing to wait for that item, I'll address it then.
That's fine, Jim. Okay, so we'll go on to agenda item number 6, which is to hear the request from the finance director to rebalance the town of Brantford other post-employment benefits trust, the OPEB trust. And as was mentioned, Jim did prepare a memo with regards to that request. So Jim, you want to take it away?
Yeah, I think by way of background, I think this will answer Tom's question, is that, the OPEB trust gets annual contributions, and over the last year and a half or 2 years, we did make large contributions from the medical self-insurance fund. The last one the board acted on in, I believe it was March of 2020, making those contributions. And as you might guess, when a large amount of cash ends up into the OPEB trust, you'll see attached to my memo, you can see that, as of December 31st, there was about 14.9 million in cash in the OPEB trust, which represented about 42% of the assets in the trust. And one of the challenges that we had is, what is a logical way to deploy that cash across the investment policy, and to do so in a prudent manner. So one of the things that we had to understand, and we had meetings, as Luke alluded to in his earlier presentation, with myself, the actuary, our investment folks, and I've also had conversations with the first selectman and chairman of the Board of Finance, is that, one is, if we have a large amount of cash and we are getting the actuarial benefit of that, which means that assets in the OPEB trust are getting the benefit of the assumed rate of return, which is 6.5%. But in reality, it kind of is a bit of a stretch. I think we'd all agree that you'd earn 6.5% with 42% of your portfolio in cash, given the low rates on cash in general. And so we wanted to be certain that, the actuary would still allow us to use that as a discount rate, because the actuary's opinion on that really goes into his work, or the firm's work, I should say. And the firm's work, in the end, ultimately determines a liability that gets put on the town's balance sheet. So we wanted to make sure that we didn't have to change our return on asset assumptions if we were to deploy this cash over time. And, the OPEB trust is not nearly as old as the pension plan. And so the OPEB trust basically, if we hadn't done anything, would have had about 26 years of amortization periods. And the transfers from the medical self-insurance fund basically were to try to reduce that to make us nearly 100% funded. And so then the question is, as I said earlier, how do we deploy that? And we felt that 7 years made sense based on the market cycles, and the actuary reviewed that and basically felt that, given the nature of our liabilities, that if we had deployed this over a 7-year period, that would be adequate in his opinion, and that he was still comfortable with the 6.5%. And also, then we discussed with the investment managers, well, what would be a good time to put that money to work? And we thought administratively that semi-annual would make sense, and to have the payments, coincide with the start of the fiscal year in July, where the town makes its contribution, and then also in January. So we would effectively be doing it twice a year. So those dollars end up going into from the medical self-insurance fund, go into the OPEB trust. And then dollars in the OPEB trust are now with the investment managers, and the investment managers are looking to put that to work. The first of which rebalance is one of the other spreadsheets that Luke has put together. So I'd be asking the board to discuss this and approve the rebalance on the sheet that Luke has prepared, and secondly, to adopt a policy that we would effectively put this cash in over 7 years, twice a year.
Thanks, Jim. And so, with regards to the reallocation that you sent out on Friday, I'm not corresponding that to the request, because that's showing a.
Well, they're different time periods. I used the report in my memo just to show where we were as of December 31st. That's the quarterly report. I believe that the numbers that Luke provided are based on an asset value that's was it today or Friday's, Luke?
Yeah, so the report you're looking at, this was as of Thursday. You could see in the disclosures, in the small print, it's just getting cut off. The total market value there in excess of 35 million, because we don't put all the cash into the actual spreadsheet, or it will try to deploy it. So what this spreadsheet is depicting is the 14,375,000 in cash over a 7-year time period with semi-annual payments, so roughly $1 million twice a year, will be deployed. So you could see the cash balance of 1,627,426. That actually is contemplating one of those tranches within this rebalance. So a little bit in excess of $1 million was added into the rebalance. And as you could see in the cell column, it's going to be deployed out, the majority of which will be benefited from the fixed income buckets.
Okay, but the total assets as of today are, what's the number again?
So the total assets as of Friday's close for the OPEB trust are $35,902,232.
Okay, So Jim, the sheet that on your attachment, it's close. Although it's dated December 31st, it's got an asset. It looks like $35 million, 106.
Right. Yeah, that was that's from the bound report that you have.
Right. And it's just a little confusing with the reallocation that's showing assets market value of 22 million, even though with a footnote you're saying it's the 35 million.
Right. I agree.
Okay.
Yeah,
Right,
it could be a little confusing on the eye, but that's just because the cash is held off to the side.
Okay.
So, Mr. Chairman, just to clarify, if I may, it's Michael Lepore. What we're trying to do here is accomplish, basically two things, and that is, item number one is deploying the cash from the medical self-insurance fund over the 7-year time horizon semi-annually. But in addition to that, we would continue to monitor and make recommendations for regular rebalancing, as we do quarterly, for the quote unquote invested body of the OPEB. So going forward, there'd basically be two illustrations. One is to do the normal investment consistent with what's being proposed this evening, and then two would be the consideration of rebalancing just as we do every quarter. So it's almost like a two-pronged decision going forward as to how the dollars would be invested and reallocated.
Gotcha. So you're almost tracking two groups of funds within that same trust.
Exactly.
Okay.
This is Jim Stepanek. Am I interrupting? Can I ask something?
Sir, this is not, yes, I'm not really entertaining questions from the public, to be honest with you. This is the Board of Finance meeting. You're welcome to listen, just as if we were in person. But we do not entertain questions at this point in time, other than from board members or from presenters. So I apologize. That's been our policy for years, and I intend to maintain that even in this virtual situation. So thank you.
That's fine. No problem. I was just following on Tom's question. That's all.
Okay. Thank you. So with that, Jim, you are recommending that we adopt the policy of the phase-in over a 7-year period, and the phase-in will occur semi-annually in July and January. And the proposed resolution is resolved that the Board of Finance authorizes the finance director to rebalance the excess cash in the OPEB trust each July and January for a period of 7 years. These tranches will be used to reallocate assets in the portfolio in accordance with the investment policy in effect at the time of the rebalance. That's your suggested resolution, Jim?
That's correct.
Thank you. Board members, any questions with regards to this proposal for rebalancing the OPEB trust? If not,
I'll move it, Joe. Jeff will let him move it.
By Jeff, thank you.
Second. I'll second that, Joe.
Seconded by Bob Imparato, I believe.
Yes.
And additional discussion. All in favor?
Aye. Aye.
Okay, thank you. Thank you for Hightower and GYL and Jim for those presentations and discussion. Next, we'll move on to item number 7, which is to hear a request from the James Blackstone Memorial Library for replacement of the HVAC, heating, ventilating, and air conditioning chiller and duct cleaning. This request will be accompanied by a request from the finance director to establish a sinking fund pursuant to the board's approval of the following resolution. And I'll read the proposed resolution. Resolved that the Board of Finance authorizes and recommends to the RTM the establishment of the James Blackstone Memorial Library Sinking Fund which will initially be funded through a contribution from the library. And
Yeah, Joe, I could start this off.
sure, I was going to just say before you get going, Jim, that we've received a memo from you, and we received a memo from the library with backup with regards to the proposed vendors, with regards to the duct cleaning and the chiller replacement. So, Jim, take it away.
All right, sorry, I jumped the gun there a little bit. Basically, I think that this is we are at an important juncture as it relates to the library, and I think we have some unique opportunities to do some good things long-term for the town of Brantford. I think if we look back over the last budget process, there was a commitment on the part of the appropriating bodies. There was a commitment on the part of the trustees to basically enhance the understanding of library finances, to be more transparent about library finances, and to help decision makers make better decisions as it relates to funding of the library. And, you know, there was also a change in some trustees, a change in treasurers. And so there was a renewed commitment to try to do that. I was part of that over the summer. I was asked to talk about the budget process and how the library fits into that. During that discussion, I had raised a concern I had about the present withdrawals from the endowment and recognizing that no one, I believe, that I've ever spoken to on the Board of Finance or the RTM would ever suggest that the endowment should be treated as a declining revenue stream, that I felt that this was a good opportunity to take a look at that, primarily because interest rates were so low. And as I said earlier, there was some concern about whether those withdrawals were safe and sustainable. And so we began this process, and the board has been part of this, Board of Finance. In the fall, we had 2 meetings in which we looked at that. We recognized a couple different things. We recognized, one, that the library provides a good value to the town. The town funds 85%. I used the analogy of going to Stop and Shop and buying $100 worth of groceries and getting a 15% off coupon. I think that's one way of viewing the library. Harry D'Adamo also noted that, in effect, we're all working for the benefit of the citizens of Brantford, whether they're citizens on the Board of Finance, citizens on the RTM, or citizens on the library board. And we wanted to engage in the investment consultants to take a look at withdrawals on the endowment and to try to come up with a safe withdrawal target, working with the then library treasurer, Adam Spilka, and other members of the board to do that analysis with Hightower. And we settled on numbers in the 3%, the 3.25% range. Our preference was for the lower, the better. But we also recognized that if we did that, there would be some implications. And the implications would be that we'd have to fund the library at a higher amount than we have historically, because one, that lower withdrawal rate meant that there was less money coming out of the endowment. And secondly, we also knew that we would have to make up for the library's funds being held flat in the budget process. And then throughout the year, we continued those discussions, and a couple things happened. The library, some good, some challenging. The library basically received some grants that they did not anticipate when they developed their budget, and they also received a donation that they did not anticipate coming in. So that's on the positive front. On the negative front, they had a chiller, an HVAC chiller that was basically need to be replaced. And in doing so, there was a great need to do massive duct cleaning at the library. So looking at all these things kind of coming together at once, coupled by the fact that it was reported back to me by a number of sources that the library trustees, in addition to the liaisons or ex officio members from the appropriating bodies, were talking about the idea of a sinking fund. And so this board, the Board of Finance, is certainly familiar with those. We use them for a variety of purposes in town, whether it's vehicle replacements or equipment replacement at the treatment plant. And we've had some success in using them, and primarily because it helps smooth the budget impacts while allowing us to make purchases over a period of years. So I was listening to that and understanding what the needs were with the chiller, and also recognizing where we were with the endowment. And it seemed to me like we had a great opportunity to kind of put all of these events together and put the library on a stable funding path. One was to take less from the endowment. Two was to use these one-time windfalls, the unanticipated grants and the donation, not to basically offset the town's contribution next year, which may seem counterintuitive at first, but instead to align that with that capital need of the chiller and the duct cleaning, and then also recognize that with the lower funding out of the endowment, as I said earlier, that would essentially result in a higher contribution for next year. But once you did that, the library would then more or less go on what would be a normal path going forward. But at the end of the day, you would get a sinking fund set up, which has been one of the expressed things that I heard. It's something somebody wanted to do. It puts the library on a stable funding path, which I think all appropriating bodies would like, starting in 23. And it preserves the endowment, which, as I said earlier, everyone acknowledges that should not be a declining revenue stream. And the library is actually paying for the chiller and the duct cleaning, because they would actually be writing a check to the town to actually prime the sinking fund, which then we could look at going forward. So when you kind of look at the whole picture, I see it as accomplishing a lot of the goals that we set out to. Part of this effort tonight and the committee process at the RTM and full RTM later than the budget process is to continue that dialogue in terms of enhancing the understanding of how all these things are connected. And sometimes the connections aren't always obvious. One example that we brought up in the fall was Foot Park. Foot Park is an outside trust, which is managed by the division of the Bank of America. And even though that's not technically a town asset, it's not on a town's book, that impacts us in terms of how we are able to take care of the park and provide park services. And certainly, Jamie and myself, when we're at meetings with the other beneficiaries, we've been pretty adamant about wanting to make sure that trust is preserved for the foreseeable future. And I think you could apply the same logic to the endowment, where there's an outside trust managed by an agency that's separate from the town legally, but certainly linked to the town in terms of its funding needs, and the town is linked to it in terms of its library needs. So when you really look at it, even though the governance structure is a little bit different, there's a symbiotic nature between both organizations. And we feel that there's a rare window of opportunity here to make a lot of these things happen. Again, setting up the sinking fund, have it funded by the library, wean off these one-time one-offs to try to balance the budget and put the endowment on a stable funding path. So I'm actually pretty excited. I think this is a great opportunity. Yes, I recognize that potentially there could be a higher budget for the library next year. But I think once we take that bite going forward, I think we'll be in a much better place. And with that, I'll quiet down now. Also,
thanks, Jim. So I know the board members have questions. Jeff, you wanted to ask a few questions?
Yes, Joe. So in Jim's presentation, of course, as a liaison from the board to the library, I did bring up about, establishing a sinking fund for things of this particular nature at the library, which I am in favor of. But, I do have a couple questions, like the replacement of the chiller. I understand it's beyond its useful life. I'm familiar with some, HVAC in my own experiences that had to get replaced after 20 years or so. But my concern is, like, why wasn't this taken into consideration? We're working on the construction of the library to factor that into that whole project, similar to the roof project that we had to, again, allocate additional funds for. So, and I got a little bit of concern on that. And with that being the case, are there other issues that may arise that are going to need attention that we may need to allocate additional funds to? I appreciate the library funding the Seeking Fund and starting the process off. I think that's great. But that was one of the concerns I had. And two, the proposed quotes that are put together, I do see that they're dated about 18 months ago on one of them and one about a year. And one of them does say they're going to hold the price. Are these solid numbers for us to vote on tonight? Or do we need to go out and get some other quotes or bids?
I'll ask Karen or Adam to comment, please.
Yes, so this is Karen Jensen, Library Director. Thank you for the questions, Jeff.
You're welcome.
The chiller was at the end of its life last summer, and the building committee did consider including the replacement in the project, but the cost would have been higher because we would have had to pay supervisor to supervise the installation and the 5% markup to the construction company. So since this was a maintenance item, we decided not to do that and to look at other options for funding it. And the quotes, they have been, yes, they're older quotes, but we checked with the companies and they're holding the quotes.
Okay, thanks, Karen. Jeff, does that answer your question?
I'm good. Thank you very much.
Okay. And Adam, do you have any, Adam or Karen, do you have any comments with regards to Mr. Finch's presentation with regards to the Seeking Fund?
This is Karen, and I would defer to Adam on that.
Adam, you're up. You have to unmute.
I have unmuted. Just first, a quick word about me. When I was last before the Board of Finance, I was the treasurer, relatively recently elected. Over a few months, it became clear to me that through her natural talents, her training, and her experience, Janice Kochanowski would be, frankly, a far superior treasurer. And so she now stands in that role, and I'm before you as the assistant treasurer. Jim's summary of where we're at was exemplary. It's been a complicated budget season for us between the flat funding last year, creating a sustainable endowment, a sinking fund, the need for the chiller, and some unexpected funds as a result of the forgiveness of a loan. There are a lot of moving parts. So I think the burden that the library will have is explaining these things in a way that they all cohere and make sense. And frankly, Jim's summary of it, it's hard to imagine somebody doing a better job than that, frankly. We'll be going into more detail once the board has adopted a proposed budget on the 3rd. But this is very much where we're at right now.
Okay, thank you, Adam. Appreciate it, and Karen. Questions from the board with regards to this proposed resolution of adopting a sinking fund for the library?
Joe?
I have a question. I have one too.
Charlie, okay, we'll let Charlie go first.
Okay. So I'm not against the sinking fund for the chiller, but I just wonder whether does duct cleaning a good candidate for a sinking fund? I mean, to me, duct cleaning is like periodical, or periodic. Maybe every of the year, something like that, more frequent. So would that qualify as a candidate to put in a sinking fund?
I'll ask Jim to jump in, but I think in this regard, I think they, because they're setting up a sinking fund, there may be some periodic type of, I'm not sure that the duct cleaning will be done every year, but on a periodic basis. But it's not necessarily a capital. I guess it could be regarded as a capital item, but not like as much associated as the chillers. But I think it's an extraordinary cost that's not ordinarily part of the operating budget. So, Jim?
Yeah, I think that, the sinking fund, the nature of it is that you're, sinking money into it for future uses. And, when we were discussing it with members and the trustees, I think I might have even referred to it as a, kind of as a capital and non-reoccurring items, because there are certain things in there that you wouldn't necessarily think of as a traditional capital. For example, if you have to, hire a consultant in later years for a strategic plan, phone systems, yes, a phone or two wouldn't be something that you might put in there, but one breaks, you might replace it. But if you're doing a system, you would do that. And I think, to your point, Joe, is that given the dollar amount required and how comprehensive the duct cleaning is, it's really something that you need to really get the boulder moving. And so it would take it takes an effort. And then going forward, you may clean it less frequently. So, but if you knew, for example, you had to clean it every, pick an interval every, 5 or 6 years, then your sinking fund plan would need to incorporate that. But saying that it needs to be done now, it seems like it would be a good candidate. And, quite honestly, I think it's important to underscore again that this is something that the library is actually paying for. So whether they was in the sinking fund or not, from our perspective, we're not necessarily taxing for it. But I do think that, probably going forward, these are the type of things that would start getting built into this type of fund. And again, it's going to mature and evolve as we work through it, assuming that the board approves it tonight. And I do want to underscore as well, because I know that this is where it's going to get tougher in another month, is this is going to have an impact on next year's budget as it relates to the library. And I've tried to be very transparent about that. But again, when we get to that, I want folks to at least acknowledge that we've discussed it tonight in the context of this. That is, if we were to identify one disadvantage of the plan, is that we'd have to fund more next year. But a lot of those, the reason we would be are policy decisions, a policy to flat fund the library, a policy to use the lower endowment, and a policy to use some of that grant and donation to plug a potential gap in the current year. So we'll be talking about it some more in the future, I suspect. And but I do think, like I said earlier, I think it's a good opportunity, and we'll do our best to make sure everybody understands all the elements and how they work together.
Okay, Charlie, is that to answer your question? Bob, you had a question?
Yeah, I just want to get some clarity on this. So the Blackstone, if I understand this, Jim, correctly, the Blackstone's going to make the initial contribution into the sinking fund. And then any additional funds from year to year may be a contribution from the Blackstone, or it may come out of our budget. Is that correct?
I think that in all likelihood, that the contributions will be coming from the town, unless some extraordinary event happens. And I also think, as we said in the fall, that generally speaking, we like to see extraordinary events go to the benefit of the endowment. But in this case, we were sort of putting the endowment on track, and this was a little bit unusual, because if you think about it this way, Bob, and this did come up in discussion, so your question is one that was raised before, is that realistically the library is getting its money from the town. So for the library to contribute to the sinking fund, in effect, it would be giving us money back that we gave them. So it kind of would cycle back. So I envision generally, like I said, unless there are some exceptional circumstances, that the sinking fund would work similar to what it does in other departments, where we would set it up to where we're funding the library sinking fund at a somewhat level pace going forward, and then the library can manage around that and work to the benefit of what their needs are. Similar to what we do with, say, elderly Dagmar's group, the senior center. We're funding the sinking fund at $30,000 a year, and given the opening balance and items that they need, they're able to do that. Similar to what we did about a year and a half ago with the Board of Ed with the technology plan. So they're a little bit hard to start, but once we get them going, we've had some success with them. Did I answer your question?
Yeah, that's exactly what I thought was happening. Yep. Thank you.
Yeah, and I think I think with all due respect as well, that what the Board of Finance recommends to the RTM is subject to their process, and that's really we might recommend down the road, Bob, that 35,000 or 50,000 or whatever number goes in to that sinking fund, just like any other sinking funds, it would be subject to the RTM process. So
agreed.
So and again, I think, Jim, you've done a great job on really bringing out the issues over the past 6 months with regards to the library, the controversy around the last budget process, and working with the library folks and others and the consultants to really put this together. So, and again, it's a bit of a philosophical discussion at some level, and it's a financial discussion. So what we decide at the Board of Finance, again, is subject to the rest of the process. And that's the way it works. That's what makes our town good and great. So we try to be as open as possible and as transparent as possible with the numbers and really where this is headed. So, and as you say, Jim, there'll be more to come with the budget process, because among other things, we have to balance the requests of all departments. So if any other questions with regards to this request from the board? If not, I will entertain a motion if the board wishes.
I'll move it, Joe. Bob.
The motion's been made by Bob. It's seconded.
Second it.
Jeff is seconded. Okay,
Perfect.
Thank you. I picked up Jeff on that one. Discussion? All in favor?
Aye.
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 Okay, thank you, folks. Item number 8 is to consider and act on the following proposed resolution. Resolved that the resolution entitled Resolution with Respect to the Authorization, Issuance, and Sale of Not Exceeding $24 million Town of Brantford General Obligation Refunding Bonds, authorizing combining into one issue and making determinations with refunding bonds, any other authorized but unissued bonds of the town, and authorizing agreements for the investment of the refunding escrow and its reinvestment over its term, to be adopted and recommended for adoption by the representative town meeting. And this is a proposed discussion or proposed resolution with regards to discussion on refunding and refinancing some of the town's existing debt. I'd be happy to, at some point, read the entire resolution, or would also entertain a motion to waive reading of the entire resolution.
Motion. Joe, Bob.
Thank you, Robert. Motion to waive.
I'll second it, Joe. Jeff.
The motion's been made and seconded. Discussion. All in favor?
Aye.
Aye.
Okay, so Jim, you want to lead us through the conversation and discussion on this?
Sure. I'm sure many of you, when you saw the agenda item and backup and you saw a refunding resolution, you probably said, oh, here we go again. But basically, it's an understatement to say these are interesting times, but they are. And one of the things that we're looking at is doing a bond refunding of the 2017 and 2018 issues, of which in combination there's about 21.3 million in outstanding bonds. The resolution is for 24 million because there's a lot of other elements that go into this. Just to give you an idea, a refunding report's like a 25-page report. There's escrow funding. There's fees, although the fees are a small piece. In this one, the fees would be about $100,000 for the production of this, and then the advisor's fees, bond counsel fees, et cetera. And that's all baked into the savings. Sometimes bonds are sold at premiums. Sometimes they're sold at discounts. The interest rates in the escrow are lower than the rates at the bond in the early maturities, given the way yield curves work. So there's a lot of nuts and bolts with this, which I won't get into. Sort of at the high level, you have two potential proposals based on a number run in the attachments. And one was, do you refund these bonds using taxable or tax-exempt debt? And there's a history with that. And so let's first figure out, or let's first explain, I know you guys have the memo, but somebody may be watching this at home, is, well, what is it? What type of refunding is Brantford considering? And these are what are called advance refundings, because we're going to be refunding debt that cannot be refunded until 2023. And so that's called an advance refunding because it's well in advance of 90 days from the call date or redemption date. If we were doing this 89 days or 90 days from the redemption date, it would be called a current refunding. And current refundings can still be done with tax-exempt debt, but advance refundings, you had to issue taxable debt. And you may say, well, why is that? Well, that's because in 2017, the Tax Cuts and Jobs Act prohibited municipalities from issuing tax-exempt debt for these refundings. And taxable debt costs more than tax-exempt debt. So issuing refunding bonds taxable otherwise lowers your savings. The fact that you could issue taxable debt and still get savings on a refunding is in and of itself pretty amazing. But like I said at the onset, these are interesting times. So when you look at the difference between the two options, and when I asked the underwriter to run a tax-exempt refunding, they said that, that they're not allowed, they're not legal. And I said, no, I understand that. I said, I want to be able to control for the tax law change. And that's why you'll see on the tax-exempt refunding, it says assumes tax-exempt refundings are allowed. And the reason I wanted to have that comparison, because Jamie and I wanted to write, and we drafted something to our our two U.S. senators, Senators Murphy and Blumenthal, as well as Congresswoman Rosa DeLauro, because we wanted them to push for this, because we felt that the climate in Washington was more friendly to this type of change. And so, but right now the law is that you still can only do taxable refunding. So I'm not asking that we do anything right now other than approve the resolution. And I'm recommending that the RTM approve it as well, so that we basically wait and see if we can get a legislative remedy. And I know somebody might be analyzing this and saying, well, you know, is it a bird in the hand versus two in the bush? If you can get roughly 800-something thousand in savings today, do you really want to take the chance and see if you can get another $1 million in savings down the road? And generally, I would say, I think it's worth the wait for a couple reasons. One is that's a lot of money. Two is that I think you can make the case that the climate is more friendly to repeal this. It's not as controversial as the state and local tax issue, which is really kind of, you know, the government's going to have to come up with funding to make up for that. And the other risk is that interest rates actually move away from you. So the risk is that the law doesn't change and interest rates move away from you. And then you might have wished that you'd done the taxable refunding. But I think in reaching out to the National Government Finance Officers Association, I actually had written them last week via email, asking them what their prospects were, what their federal folks were telling them at the Capitol in terms of whether they thought this would actually happen. And I told them I told them what our numbers were, and I told them that I was writing to our senators and congresswomen, and the director reached out to me and basically asked if I could wait. She said that because in March, there's going to be language in President Biden's infrastructure bill, which would essentially restore tax-exempt advance refundings. Now, obviously, there's no guarantees, but if that ends up being the case, then Jamie and I will turn around and we'll send that letter out, and then we'll have a legislative identifier, something to cite to identify, asking our senators and congresswomen to support this. And if that happens and we position ourselves well, we'll be able to react pretty quickly because we would have already had our authorizations in place, and we would have already started working on some of our due diligence, our rating presentations, et cetera, to take advantage of this. So understanding that, yes, if you wait, you have to be right twice. You have to be right that rates aren't moving away from you, and you have to be right that that the legislative remedy will happen. But I do think, without jinxing it, I do think there's probably a good chance that what the folks are telling me down in Washington are true. My casual understanding of watching the nation's politics, and I emphasize casual, is that if this is part of an infrastructure bill, my sense is that infrastructure bills are probably the type of bill that you can get 60 Senate votes on. So if it's part of that, and it's not, a showstopper like state and local tax, restoring the state and local tax deductions, then I have to take the National GFOA director at her word by saying that there's a good chance this will happen. And, I think we can do continued outreach on this. I had done outreach on this before back in 2017 unsuccessfully, but I did do some outreach on it when I held a position with the New England GFOA. And if there is such a bill, I know Jamie's going to make some calls. I'll make some calls. We'll call the mayor of New Haven. We'll call the folks up at Hartford at the state treasurer's office if they're not already on this. And we'll do what we can, and we'll, and hopefully we'll get that changed. But right now, all I'm asking really is for the Board of Finance is to recommend this resolution to the RTM so that, again, we'll be in a position to act if the conditions are such that these advance refundings are restored. So that's essentially what's before you and what I'm asking.
So, Jim, what's plan B if, in fact, you would recommend issuing the taxable bonds if, in fact, Congress does not act in that way?
I would have to come back to that, and assuming if rates stayed about where they were, then the savings should be about where it is. Hopefully, let's hope it doesn't come to that. So,
right, and what your time frame is? What at this point?
Well, right now, your time frame for the approval or time frame to making a decision?
Both.
Okay. Well, assuming the board was to act on this tonight, I would have to go to the RTM. I would offer the same explanation, and then I would cross that off my list. So I would think that in March, if things go normally, I would have the approvals in place. And then I would be watching to see whether Biden's infrastructure plan does come out, and it does have this in there. I think I'd be willing to wait as long as we can until other folks that I work with thought rates were moving away from us. And again, even if they move away from us a little bit, I'd want to see where the legislation is. So I think it's more or less responding to conditions. If conditions were that, this was part of it, and I can get a clean opinion from bond counsel that we can do this, then I think that we would basically get ready to do it, and we could pull the trigger before the fiscal year is over.
Okay. Thanks, Jim. Questions from the board on this? Comments?
I'll move it, Jim. Bob Imperato.
You're moving it, Bob?
Yeah.
Second.
And seconded by Victor. Thank you. Additional discussion on this? With none, all in favor?
Aye. I'll go along. Aye.
Okay. No opposed. All right, Jim. Good luck. Keep us posted.
All right, I will. Thank you.
Okay. Don't believe we have any other agenda items. Mr. Cosgrove, you're doing well?
Hey, Joe, thank you. I'm doing well. Thanks.
All right.
Great meeting.
Okay. With no other business to come before the board, I'll entertain a motion to adjourn.
So moved.
Been moved and seconded by Mr. Vallette. All in favor?
Aye. Aye. Aye.
Thank you. Thank you all.
Thanks a lot, Joe.
Thank you, Lisa.
Thank you. It's 9 p.m. for the record. Have a good night.
Night.
This program was brought to you in part through the support of the Town of Brantford. Watch town meetings and other videos on demand at BrantfordTV.org.